Two people. Same age, same city, same $52,000 saved. One buys a rental property, the other puts everything into an index fund. 20 years later, they're in roughly the same place in terms of net worth. But how they got there, the time it cost, the stress it produced, the sleep it interrupted, the flexibility it took away, is completely different. And that difference, I'd argue, is the actual investment decision, not the number at the end. Today I want to walk through this comparison honestly, with real numbers, over a real timeline. And at the end, I'll tell you where I land personally, not as advice, but as a position. Because I think too many people in this space present numbers without a view. And I'd rather tell you what I think and let you disagree than hide behind false neutrality. Nothing in this video is financial advice. I'm a 38-year-old dad who works from home, thinks about money, and has formed opinions over time. Take what's useful. Let me introduce two people, Ryan and Alex. Same age, same city. Both have $52,000 saved. Both earn $55,000 a year. Financially, they're starting from the exact same place. The only difference is what they do with that $52,000. Ryan uses it as a 20% down payment on a $260,000 rental property, a 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 6.8% interest. His monthly mortgage payment is about $1,356. He finds a tenant willing to pay $1,900 a month in rent. On paper, $544 a month in profit before expenses. Ryan feels like a genius. Alex takes the same $52,000 and puts it into a total stock market index fund. No leverage, no tenants, no property to manage. He sets up an automatic contribution of $320 a month and largely doesn't think about it again. On day one, Ryan has a house, a tenant, and a story to tell. Alex has a brokerage account and a confirmation email. In terms of how it feels, it's not even close. Ryan is winning. But feelings and math are different things. I want to pause here before the numbers, because I think the social dimension of this is real and underappreciated. When Ryan tells people he owns a rental property, there's a specific response. People are interested. They ask questions. There's something tangible, something respectable, something you can point to. Real estate has a cultural authority that stocks don't have. When Alex says he invests in index funds, people nod politely and change the subject. Nobody is impressed by a brokerage account number. It doesn't make a good story. And this social pressure, the feeling that real estate is a real investment, while index funds are somehow passive or unambitious, shapes a lot of financial decisions. It shaped mine for longer than I'd like to admit. For the first few years, Ryan is living the landlord fantasy. Rent checks arrive on the first of the month. He drives past the property on the way to work and thinks, I own that. He's claiming mortgage interest and depreciation on his taxes. He's building equity with every payment. Comparable homes in the neighborhood are ticking up. Everything about this feels real, tangible, and smart. Alex, meanwhile, logs into his brokerage account once a quarter. Year one, his $52,000 has grown to about $57,000. Year two, maybe $63,000. Nothing dramatic. No story to tell. Just a number on a screen, moving slowly upward. Now let's look at Ryan's actual numbers through year three. He's collected roughly $64,800 in rent. His mortgage payments total about $47,880. That leaves around $16,920 in gross cash flow. Sounds good, until you subtract what actually happens. Property taxes, roughly $3,000 a year. Insurance, $1,500 a year. A water heater replacement, $1,200. A leaking roof repair, $2,800. 1 month of vacancy between tenants, $1,900 in lost rent, plus $600 in cleaning and relisting costs. And Ryan is managing the property himself to save money, which means phone calls at 10 p.m., weekend showings, coordinating repairs on his lunch break. After all real costs, Ryan's actual net cash flow over 3 years is somewhere between $2,000 and $4,000. Not $16,920, $2,000 to $4,000. And that doesn't count a single hour of his time. Alex at year 3, $52,000 initial investment, plus $11,520 in contributions. At roughly 10% average annual return, his portfolio is sitting at about $81,000. He spent 0 hours managing it, 0 phone calls, 0 emergencies. But, and this is important, Ryan still has leverage working for him. His property, which appreciated 3 to 4% annually, is now worth roughly $285,000 to $292,000. His equity has grown to approximately $85,000 to $90,000. That equity came partly from using the bank's money, and that leverage is real. It's the one structural advantage that real estate offers that stock investors can't easily replicate. The rent check is the number everyone talks about. It's the number on the YouTube thumbnail, the number at the real estate meetup, the number your landlord friend brags about at the barbecue. What nobody talks about is everything that comes out of that rent check before you actually keep any of it. Let me go through this carefully. Vacancy. The average rental property sits empty roughly 1 month per year. That's not a disaster, but it's a full mortgage payment with 0 income to cover it. Think about what that means. 1 month of vacancy is $1,900 of lost income. The mortgage still gets paid. Net hit, over $3,000 in a single month. And this happens, on average, every year. Maintenance and repairs. The general rule is to budget 1 to 2% of the property's value per year. On a $260,000 house, that's $2,500 to $5,000 annually. Some years, it's a $200 faucet fix. Other years, it's a $7,000 HVAC replacement in August that you can't postpone because your tenant is threatening to leave. The random nature of this is its own kind of stress. You cannot predict when the furnace will fail. You cannot predict when a pipe will burst at 11 p.m. on a Saturday. When it comes, it requires immediate response, whether or not the timing is convenient. Capital expenditures. Roofs last 20 to 25 years. Furnaces 15 to 20. Water heaters 10 to 12. These are guaranteed future costs, and they come in large chunks. $5,000 to $15,000 at a time. If you're not setting aside money monthly for these, you're not running a business, you're running on luck. Most beginner landlords skip this. They see the rent coming in, they feel like it's profit, and they spend it. Then the roof needs replacing, and they're scrambling. Property management. If Ryan hires a manager, that's 8 to 10% of monthly rent gone immediately. About $150 to $180 a month. If he manages it himself, he's working a part-time job he's not being paid for. There's no neutral option. Either you pay money or you pay time. And then there's the risk nobody likes to discuss. Bad tenants. A tenant who stops paying and understands the eviction process can cost 3 to 6 months of lost rent plus legal fees. Evictions take time, require legal process, and in many jurisdictions take months, even in clear-cut cases. During that entire period, the mortgage still needs to be paid. A single event like this can erase an entire year's profit, sometimes more. None of this appears in the $544 a month cash flow number, but all of it appears eventually. And to be fair, index funds have real risks too. Volatility is brutal in a way that feels different from real estate. In 2008, the market dropped roughly 37%. In March 2020, it dropped 34% in a few weeks. If Alex had $150,000 in his portfolio and watched it fall to $95,000, that's not a number on a screen. That's gut-wrenching. The data on what happens next is uncomfortable. Most ordinary investors panic sell during crashes and buy back in after the recovery. They lock in losses at the worst possible time and miss the rebound. That requires a specific kind of patience, the ability to watch your account drop significantly and do nothing. For some people, that's manageable. For others, it isn't. There's also no monthly cash flow. Dividends on a total market fund run about 1.5 to 2% annually. On $150,000, that's roughly $200 a month. Not replacing anyone's income. And no leverage. Alex used $52,000 to control $52,000 in assets. Ryan used $52,000 to control $260,000. That 5-to-1 leverage is the single biggest mathematical advantage real estate offers. When values rise, gains are calculated on the full amount, not just the down payment. These are real differences, not hypothetical ones. By year 5, Ryan is deep in the reality of being a landlord. He's on his third tenant. He's replaced the roof, $8,500. Dealt with a plumbing emergency, $1,400. Had a month with the property empty between tenants. Each of these events required his attention, his time, and in most cases, his money before the rent came in to cover it. He's raised rent to $1,950, which helps. But property taxes and insurance have gone up too. His actual cash-on-cash return, the money he pockets relative to the money he put in, is hovering around 3 to 5% after all real expenses. Not bad, but not the 15 to 20% he told his friends about at the barbecue. And here's something worth saying clearly about that gap. The 15 to 20% return that gets talked about in real estate circles usually includes appreciation, the increase in property value, as part of the return calculation. That appreciation is real, but it's also unrealized. It's not money you can spend. It's equity locked inside the property, accessible only when you sell or borrow against it. The actual cash return, the money that arrives in your pocket after expenses every month, is often significantly more modest. 3 to 5% is realistic for many landlords in many markets. Some do better, some do worse. Alex at year 7 has done absolutely nothing. His portfolio has grown from $52,000 to roughly $135,000 to $140,000, including his $320 monthly contributions. He didn't pick stocks. He didn't time the market. He just didn't touch it. The compound growth is starting to accelerate. The gains on his gains are now generating more new wealth each year than his original contributions alone. This is the thing about compounding that's hard to intuit until you see it in your own account. In the early years, the growth looks like a small number getting slowly bigger. Nothing dramatic. Nothing that makes a good story. But underneath the surface, the mechanism is building momentum. The return on $150,000 is 3 times larger than the return on $52,000. And the return on $310,000 will be twice that again. The curve is bending, slowly at first, then faster and faster. Year 7 feels underwhelming. Year 15 does not. At year 10, Ryan's property is worth roughly $335,000 to $350,000. His remaining mortgage balance is about $178,000. His equity, approximately $170,000 to $184,000. Over 10 years, after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, Ryan's total out-of-pocket beyond the down payment is between $22,000 and $38,000. Alex's portfolio, with consistent contributions and roughly 10% average annual returns. Approximately $165,000 to $180,000. He put in $52,000 up front, plus $38,400 in contributions. $90,400 total. The rest is compound growth. 0 weekends fixing anything. At year 10, they're surprisingly close in total wealth. Ryan might be slightly ahead due to leverage, but Ryan also spent hundreds of hours managing the property, took on significant debt, and concentrated his entire investment in a single asset in a single zip code. Alex diversified across thousands of companies and, frankly, didn't lose much sleep. By year 20, here's where each person lands. Ryan's property, worth roughly $450,000 to $500,000. Mortgage either paid off or nearly there. Total equity, $400,000 to $500,000, depending on appreciation. After 20 years of maintenance, repairs, turnover, taxes, insurance, and at least one major renovation, his total net profit from cash flow, above what he spent, is somewhere between $40,000 and $80,000. Maybe more in a hot market, maybe less in a flat one. Alex's portfolio, with $320 monthly contributions and 10% average annual returns, the $52,000 original investment has grown to approximately $520,000 to $540,000. Total contributions over 20 years, $122,000. The other $300,000 plus, pure compounding. No debt, no tenants, no 2 a.m. phone calls about broken pipes. When you compare net worth, they're in the same ballpark, $400,000 to $500,000 each. But how they got there is completely different. Ryan worked for his. Alex waited for his. Ryan had stress, concentration risk, and illiquidity. Alex had volatility, but liquidity and freedom. And here's a detail that changes the math significantly. If Alex had increased his monthly contribution by just $200 more, bringing it to $500, his 20-year portfolio jumps to roughly $550,000 to $600,000. Because in the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying another property, another mortgage, and doubling your workload. I want to be fair here, because if I only showed the downside of real estate, I'd be doing what every stock market influencer does. Real estate wins in specific, identifiable situations. If you're in a market where the rent-to-price ratio is strong, where monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. That's genuinely rare, but it exists. If you treat it as a business, not a side project, screening tenants carefully, budgeting for capital expenditures, building real systems, the returns can exceed stocks, especially with leverage. There's a strategy called house hacking. You live in one unit of a multi-family property and rent the others. You reduce your own housing costs to near zero while building equity. That's something the stock market simply can't do. And the tax treatment of real estate is genuinely advantageous. Depreciation, deducting the theoretical decline of your building from taxable income, even if the property is actually appreciating, is a legal tax shelter that stock investors don't have access to in the same way. Real estate isn't a bad investment. It's often a misunderstood one. The real trap isn't choosing real estate, and it isn't choosing stocks. The real trap is picking either one based on a headline, a podcast clip, or something someone told you at a party, without ever running the actual numbers for your own situation. Okay, my view. I'm on Alex's side of this. Not because the numbers necessarily favor him dramatically. Over 20 years they're closer than most people expect. But because of two things that matter a lot to me specifically. The first is liquidity. Real estate is not a liquid investment. If you need the money, if something changes in your life, if an opportunity appears, if you need to access capital quickly, you cannot sell a house the way you sell shares. Selling property takes time. Months, often. It involves agents, closing costs, inspections, negotiations. If the market is soft, you might have to wait significantly longer, or accept less than you wanted, or both. And here's the specific version of this that applies to me. I'm the sole income for my family. That means if something goes wrong, if a month is hard, if an unexpected cost appears, if the income dips, I need options. I need flexibility. I need to be able to access capital without a 6-month selling process. If my money is sitting in an index fund, I can access it, not without cost. Selling during a downturn hurts, but I can access it. The option exists. If my money is sitting in real estate equity, it's locked in. Getting to it requires either selling the property or taking out a loan against it. Neither of those is fast or simple. For someone in a different situation, stable income, dual earners, more cushion, this matters less. For me, it matters a lot. Index funds, by contrast, can be sold in minutes. The money is in your account within days. That liquidity is not an abstract benefit. It's a real structural feature that changes how much risk I'm actually taking on. The second is simplicity. Being a landlord is a second job, maybe a third of a job if you're lucky, maybe a full second job if you're not. Phone calls, repairs, tenant screening, legal compliance, vacancy periods. All of it requires attention, time, and energy that comes from somewhere. I have 3 kids. I work from home. I already manage a significant amount: the household, the income, the work, the daily demands of a family with a 3-year-old and 2 older kids in school. My attention is not infinite. Adding a landlord responsibility on top of what I already manage. I've thought about this seriously. I've run the numbers. I've imagined what the average week would look like. And the honest answer is, I don't want to do that. Not because I couldn't, but because the cost of my time and attention is real, even when it doesn't show up in a spreadsheet. Index funds require almost nothing from me after the initial setup. I set the contribution. It runs. I check it occasionally. That's it. When something goes wrong in my life, when a month is hard, when something needs attention, the investment doesn't add to that. It just continues, quietly, in the background. That simplicity has a value that doesn't appear in any comparison table. And for my situation, sole provider, full schedule, irregular income, 3 kids, that value is genuinely high. It's not the glamorous answer. Real estate makes a better story. But I'm not building my finances to have a good story. I'm building them to have a good life. I want to say something clearly, because I think it needs to be said. Both of these can work. People have built real wealth through real estate and through index funds. The math over 20 years is genuinely close. What matters is matching the investment to your actual life. If you have the time, the temperament, the local market knowledge, and the genuine interest in managing property as a business, real estate can be excellent. If you don't have those things, if you're already stretched, if you value flexibility, if you'd rather your money work without requiring your constant supervision, index funds are a completely legitimate path to the same destination. The problem isn't picking the wrong one. The problem is picking based on what sounds impressive rather than what fits your actual situation. Ryan and Alex both walked away from that decision thinking they were making the smart play. Neither of them sat down and mapped out what the choice actually costs, in dollars, in time, in stress, and in risk, over 10 or 20 years. The real estate investor counts the property value and forgets the hours. The stock investor counts the returns and forgets the volatility. And both of them sometimes forget to ask the most important question: which of these actually fits my life? Not which one sounds better, not which one has the better story. Which one fits the life I'm actually living, with the time I actually have, and the flexibility I actually need? That question, answered honestly, is worth more than any spreadsheet. I prefer index funds. For my situation, my schedule, my priorities. That's my answer. Yours might be different, and that's fine. If this landed, stick around. My preference, index funds, less glamorous, more aligned with my actual life. What's yours?